The first warning may arrive as a simple question: can you afford the monthly payment? A buyer sees a new car priced at $35,000, hears a manageable number from the dealer, and feels the pressure begin to lift. But the payment is only one piece of the record. Behind it, two clocks start moving at different speeds. The car begins losing value. The loan balance begins shrinking. That gap can quietly become expensive. A 72-month loan makes the monthly number smaller because the amount borrowed is spread across 6 years. It does not make the car cheaper. Interest continues to build over time, and the longer loan keeps you tied to the vehicle long after its newest features have lost their shine. The payment may fit the budget shown on paper, while the total cost remains far heavier than expected. The price on the window is not always the amount financed. A buyer may face sales tax, registration costs, documentation charges, and other dealer fees. Some fees are required by law or local policy. Others may be negotiable. Together, they can raise the amount borrowed before interest is added. A useful investigation begins by asking for the full out-the-door price, not just the sticker price or the monthly payment. Then depreciation begins its quiet work. Car depreciation means the loss of a vehicle's market value over time. A new car can lose a large share of its value during the first few years, even while it still looks clean, runs well, and carries the same brand badge. The market does not reward you for what the car once cost. It asks what someone is willing to pay for it now. The loan follows a different rule. Your balance falls according to the payment schedule, the interest rate, and the amount borrowed. APR, or annual percentage rate, measures the yearly cost of borrowing, including interest and certain loan charges. With a long loan, early payments may put less toward the balance than a buyer expects. The car loses value in the market, while the debt declines by contract. Imagine the $35,000 car leaving the dealership with a 72-month loan attached to it. The buyer may have made a down payment, but taxes and dealer fees could still be included in the financing. The exact balance depends on the contract, the APR, and the money paid up front. The important point is not a dramatic prediction, it is the timing. The vehicle's value can fall before the loan catches up. This creates the first hidden danger: confusing ownership with possession. A car in your driveway is not necessarily an asset you could sell for more than you owe. The difference between the vehicle's current value and the loan balance is your equity. Positive equity means the car is worth more than the debt. Negative equity means it is worth less than the amount still owed. The problem often becomes visible when life changes. A raise may make a higher payment seem possible, but a new child, a move, a repair, or a period without work can change the budget quickly. If the car must be sold, the lender still expects the remaining balance. The market does not adjust the debt because your circumstances changed. A payment that once felt small can become a fixed obligation with very little room around it. Trade-ins can make this gap harder to see. A trade-in is the value a dealer offers for your current vehicle when you use it toward another purchase. The offer may be convenient, but convenience can hide the numbers. The dealer may show a trade-in credit, a discount, a new payment, and a loan term together, making it difficult to see what happened to the old balance. Suppose the car is worth less than the loan balance. That difference is negative equity. If you trade the car before the loan is paid off, the unpaid gap may be added to the next loan. The old debt has not vanished. It has moved into a newer vehicle where it can collect more interest and remain hidden behind another small monthly payment. This is where the transaction can feel like a rescue while functioning like a transfer. The buyer leaves with a different car, but the new loan may contain the old shortfall, new taxes, new dealer fees, and interest on a larger amount. The monthly payment may rise only slightly because the term has been extended. The visible change is small, the total obligation may be much larger. A careful buyer separates every line. What is the selling price of the new car? What is the trade-in value? What is still owed on the old loan? What taxes and dealer fees are being charged? What amount is financed? What is the APR? How many payments are required? These questions turn a fast-moving sales process into a document that can be checked. Clarity begins when the numbers stop being blended together. The 72-month loan deserves special suspicion, not because every long loan is automatically wrong, but because time can disguise cost. A lower payment may help someone manage cash flow, yet it also increases the period in which the car can be worth less than the debt. Before signing, calculate the total of all payments, then add the down payment and unavoidable costs. That is closer to the real price. A 3-year-old used car changes the starting point. Someone else may already have absorbed much of the earliest depreciation. Although the vehicle's condition, history, mileage, and market demand still matter, the lower purchase price may reduce the amount borrowed, the interest paid, and the risk of negative equity. Used does not mean risk-free. It means the comparison must include maintenance, reliability, and the full cost of ownership. A larger down payment can create a stronger starting position. It reduces the amount financed and may provide more equity from the first day. But draining every dollar of savings to make the payment look safer can create another danger. A vehicle repair or job interruption can force new borrowing. The strongest plan balances the down payment with an emergency fund, which is cash reserved for unexpected essential costs. Keeping the car after the loan ends changes the math again. Once the debt is gone, the payment can stop while the vehicle may still provide transportation. That does not make the car free. Fuel, insurance, maintenance, registration, and repairs remain. But avoiding a new loan can protect cash flow and give depreciation time to matter less. The quiet years after payoff are often where the financial benefit appears. A practical car budget starts with total transportation costs, not the payment alone. Include the loan payment, insurance, fuel, maintenance, registration, parking, and expected repairs. Then test the budget against an ordinary bad month. If one missed paycheck or one major repair would force credit card debt, the car may be too expensive, even if the dealer approves the loan. Approval is not proof of affordability. A lender measures repayment risk using income, existing debts, credit history, and other details. A credit score, including a FICO score, can affect the APR offered, but a strong score does not turn an expensive car into a good deal. Credit helps measure the cost of borrowing. It does not decide what belongs in your life. The monthly payment also competes with other goals. Money committed to a long car loan cannot be used for a house deposit, career training, or retirement investing. Investing means putting money into assets with the hope of future growth while accepting the risk of loss. Diversification means spreading investments across different assets instead of relying on one. Neither concept repairs an overloaded budget. The first investment is often financial breathing room. Before visiting a dealer, write down a maximum out the door price and a maximum total transportation cost. Get financing offers from more than one source if possible. Compare APR, loan term, total payments, and required fees. Do not negotiate from the monthly payment. Negotiate the vehicle price first, then review the trade in, then review the financing. Keeping the pieces separate makes the structure harder to disguise. The trade in should be researched independently. Check several estimates for the vehicle's value and compare them with the exact payoff amount from the lender. The payoff amount may not match the balance shown on a recent statement because interest can continue until the loan is closed. The difference between value and payoff tells you whether you have equity to apply or negative equity to solve. If negative equity exists, the cleanest options may be uncomfortable. You could keep the current car longer and continue paying it down. You could sell it and cover the difference with cash if that is realistic. You could choose a less expensive replacement and limit the new debt. Rolling the gap into another loan may be possible, but possible is not the same as wise. The same scrutiny applies to add-ons, extended warranties, protection products, service plans, and other extras may have value for some buyers, but they can also increase the amount financed. Ask whether each item is required, what it costs, and whether it can be canceled. Dealer fees deserve the same calm attention. A fee should be understood before it becomes part of a 6-year obligation. Inflation adds another pressure. Inflation means prices rise over time, reducing what each dollar can buy. Income may increase, but insurance, repairs, fuel, and daily needs can rise too. A payment fixed by contract may look stable while the rest of the budget becomes tighter. This is why a car should be affordable under today's income, not only under an expected raise that has not arrived. The most useful document is a simple comparison sheet. List the new car's price, the used car's price, the down payment, taxes, dealer fees, trade-in value, old loan payoff, APR term, total payments, insurance, fuel, and maintenance. Then write the amount left each month after essential spending and savings. The answer may not feel exciting. It will be far more honest than a payment designed to win approval. There is no shame in needing reliable transportation or wanting a safer, newer vehicle. The danger is not the car itself. The danger is entering a contract without seeing how depreciation, loans, interest, trade-ins, and fees interact. A careful decision can protect your credit score, preserve savings, and prevent a temporary purchase from becoming years of financial pressure. The final test is simple. We'll ask what the car will cost in total, what it may be worth later, how much will still be owed, and whether you could keep paying through a difficult season. If the answers are clear, you are negotiating from knowledge rather than fear. A small monthly payment can hide a large commitment. Once you see the full record, the choice belongs to you.